Have you ever had one of those moments where you open your banking app, stare at the number, and feel weird about it? Not panicked exactly, just uneasy. Like, this is fine, but is it really fine? You're doing the right things. You've got money in savings, maybe some investments, a retirement account you don't look at too often because honestly, it messes with your mood. And on paper, everything works. The system works. The numbers add up. But then you hear things, inflation numbers, debt ceilings, bank failures that are contained, currency headlines you don't fully understand but still somehow feel in your chest. And you start wondering, quietly, almost guiltily, what if the rules change? Not in a dramatic, end-of-the-world way, just subtly, gradually, the way things usually change. And that's usually when people start asking strange questions, questions they didn't care about 5 years ago, like why their grandparents loved gold so much, or why central banks of all institutions still hold it, or why, despite all our technology and algorithms and modern finance, this weird yellow metal keeps showing up in the background. I think about stuff like this way more than I probably should. I'm Tim, and I spend way too much time thinking about money, financial psychology, and the quiet signals hidden underneath the headlines, the ones nobody really explains unless you go looking for them. And one of the biggest, quietest signals right now is this. Central banks around the world are buying gold. Not loudly, not with press conferences, just steadily, patiently, year after year. And once you understand why they're doing it, it kind of messes with how you see money altogether. It reframes what safe means, what stable actually looks like, and where the real risks might be hiding. So let's talk about it, slowly, honestly, no hype, no doomsday stuff, just a deeper look at what's really going on and why it matters way more to your everyday life than you'd expect.
Here's something that's important to understand right out of the gate. Central banks are not emotional investors. They don't chase trends, they don't panic buy, they don't wake up one morning and decide, you know what, gold is hot right now. These are institutions built on caution, on redundancy, on worst-case scenarios stacked on top of other worst-case scenarios. So when they do something consistently, quietly, methodically, it's worth paying attention. Gold buying isn't new. Central banks have held gold for decades, but what is new is the pace and consistency. Over the past several years, central bank gold purchases have quietly accelerated, even as public conversation focuses on stocks, crypto, AI, and everything else. And that raises an uncomfortable question. What do they see that most people don't? Because here's the thing. Central banks sit at the very center of the global financial system. They see capital flows before they show up in headlines. They stress test currencies for scenarios you and I never think about. They plan not just for recessions, but for breakdowns in trust. And gold, historically, is not about growth. It's about trust. Gold is what you hold when you don't fully trust promises. Promises like, this currency will always hold its value. This debt will always be honored. This system will always function the way it has. Central banks don't abandon those promises publicly. They uphold them. They defend them. That's their job. But behind the scenes, they hedge. And gold is the ultimate hedge against confidence itself. Why this matters to you? Because if the most powerful financial institutions in the world are quietly diversifying away from pure currency exposure, it suggests that risk isn't where most people think it is. It's not just in volatile assets, it's in assumptions. Takeaway: when institutions that create money want something that can't be created, pay attention. Let's talk about a word that sounds boring, but is actually everything here: counterparty risk. Most of your money, probably all of it, depends on someone else's promise. Your bank balance depends on the bank staying solvent. Your bonds depend on governments repaying debt. Your stocks depend on companies surviving, earning, adapting. Even cash depends on trust in the issuing authority. Gold doesn't. Gold doesn't promise anything. It doesn't yield, it doesn't email you quarterly updates, it just exists. And that's exactly why central banks care about it. If you're a central bank, your biggest nightmare isn't volatility, it's a loss of confidence, a moment where trust fractures, where systems that rely on cooperation and belief suddenly face doubt. Gold doesn't need belief. It doesn't need a functioning payment system. It doesn't need stable politics. It just needs to be there. That's why during geopolitical tensions, sanctions, trade wars, or currency disputes, gold suddenly looks very attractive to institutions whose job is never to be cornered. Here's a simple way to think about it. Gold is financial gravity. It's what everything falls back toward when trust thins out. Central banks aren't buying gold because they think the world is ending. They're buying it because they understand that trust moves in cycles, and they want an anchor when the cycle turns. Why this matters to you? Because your entire financial life is built on counterparties. Jobs, banks, markets, governments. None of that is bad, but it is fragile in ways we tend to ignore when things are calm. Takeaway. Assets without counterparty risk serve a different role than assets designed for growth. Both matter. Confusing them is where people get hurt.
This is where things get a little more delicate. The US dollar is still the world's reserve currency. That hasn't changed. And despite what some headlines suggest, it's not about to disappear overnight. But something is changing. More countries are quietly trying to reduce how dependent they are on any single currency, especially one they don't control. And gold is neutral. Gold doesn't belong to a country. It can't be sanctioned. It doesn't care about politics. If you're a central bank in a world where geopolitical tensions are rising, holding reserves entirely in another nation's currency suddenly feels risky. So what do? You diversify. You keep some dollars, some euros, some other currencies, and some gold. Because gold doesn't take sides. This isn't a rebellion against the dollar. It's a hedge against concentration risk. And central banks think in terms of decades, not election cycles. Why this matters to you? When reserve strategies change, global capital flows eventually follow, slowly, quietly, then all at once. Takeaway. Diversification isn't pessimism, it's realism. Part 4. Inflation, debt, and the long game. Let's talk about the elephant in the room. Debt. Global debt levels are enormous, historically high, and not just government debt, corporate, consumer, everything. Debt itself isn't bad, but debt plus inflation plus long timelines creates pressure. Pressure to grow, pressure to print, pressure to devalue slowly rather than default loudly. Gold tends to benefit in those environments, not because it beats inflation perfectly, but because it doesn't get diluted. You can't print more gold because you're uncomfortable with the math. Central banks understand this deeply. They're the ones managing the trade-offs. They know that over long periods, currencies tend to lose purchasing power, not because of incompetence, but because that's how the system is designed to function. Gold sits outside that design. Why this matters to you? If your entire financial plan assumes stable purchasing power over decades, you're making a bet, whether you realize it or not. Takeaway. Long-term thinking requires assets that survive long-term incentives.
Here's a subtle point that doesn't get talked about enough. Gold isn't just financial insurance, it's psychological insurance. Central banks hold gold partly because people believe in gold, and belief matters in crises. When things feel unstable, gold reassures. It signals permanence. It's a confidence anchor. And central banks, more than anyone, understand the power of perception. Why this matters to you? Markets don't just move on numbers, they move on narratives, on fear, on confidence. Takeaway? Sometimes stability is as much about psychology as math.
If there's one unfair advantage central banks have, it's time. They don't need quick wins. They don't need quarterly performance. They plan for 10, 20, 50 years out. Gold fits that timeline. It's boring, slow, unexciting, and incredibly patient. In a world obsessed with speed, patience becomes power. Why this matters to you? Most people underestimate how powerful long-term thinking really is. Takeaway: the most boring assets often do the most important work. Let's be clear about something. This does not mean you should dump everything and buy gold. It does not mean stocks are doomed. It does not mean collapse is imminent. Central banks aren't making all or nothing bets. They're balancing risk. And that's the real lesson here. Why this matters to you? Overreaction is just as dangerous as complacency. Takeaway: think in layers, not extremes. So what do you do with all this? You zoom out. You stop thinking in binaries, safe versus risky, growth versus fear. You start thinking in roles. Some assets grow, some protect, some stabilize. Gold's role isn't excitement, it's resilience. And even if you never buy a single ounce, understanding why powerful institutions do helps you think more clearly about your own financial life. Why this matters to you? Clarity beats complexity every time. Takeaway: you don't need to copy central banks, you need to understand them.
If you take nothing else from this, take this. The most important financial shifts rarely announce themselves loudly. They happen quietly, gradually, in the background, while everyone else is distracted. Central banks buying gold isn't a prediction, it's a posture, a stance, a way of saying we're prepared for uncertainty. And maybe that's the real lesson. Not fear, not urgency, just preparedness. You don't need to panic, you don't need to overhaul your life, but you do need to think a little deeper, ask better questions, pay attention to the quiet signals. Because money isn't just math, it's trust, it's time, it's human behavior repeating itself in slightly different forms. And once you see that, you can move through uncertainty with a little more calm, a little more intention. Not louder, just wiser. And honestly, that's where real financial confidence starts. There's also something quietly humbling about gold that I think matters more than we admit. Gold doesn't care who you are. It doesn't care how smart you think you are, how advanced your financial models are, or how confident you feel about the future. It treated Roman emperors, medieval kings, industrial bankers, and modern central planners exactly the same way. That kind of indifference is unsettling and comforting at the same time. It reminds us that progress is real, but permanence is rare. And honestly, when you zoom out far enough, gold isn't really competing with stocks, real estate, or businesses. It's competing with hubris, with the idea that this time is different, that systems are now too advanced to wobble, that human incentives have somehow been upgraded. Central banks don't buy gold because they reject modern finance. They buy it because they understand human behavior hasn't changed at all. I also think there's a quiet lesson here about humility and patience. Central banks aren't rushing. They're not timing tops or bottoms. They're accumulating slowly, sometimes at prices that seem too high, sometimes during moments no one notices. That's not speculation, that's stewardship. And there's something worth learning from that approach, even if your version of it looks very different. For regular people, the real danger isn't missing the next big thing. It's building a financial life that only works if everything goes right, if markets keep rising, if currencies stay stable, if institutions behave perfectly. Gold, in its own boring way, is a reminder to leave room for error, for reality, for the fact that life rarely follows a clean spreadsheet. So maybe the deeper question isn't, should I buy gold? Maybe it's, what assumptions am I making that I've never questioned? What am I trusting without realizing it? And if those assumptions were tested, slowly, quietly over time, would my financial life bend or break?